My name is Rodney Foxworth. I am the co-founder and partner of a firm called Worthmore. I'm also a SOCAP board member. Friends with many of the folks on stage, which I'm really excited about. That's why, again, we want to make this really conversational, right? So this whole conversation is obviously, you see it on the slides, capital flows for impact. And really the conversation we're going to have today is kind of kickstarting a series of conversations the rest of SOCAP week. But one of the things that we really want to highlight is the realities of the challenges and opportunities as it pertains to actually moving capital across the spectrum into real impact. Because I'll speak for myself, and then it's probably felt by many of you in the audience as well. But as much as there's been an increase in impact investment over the last several years, the Jen cited nearly $1.6 trillion under management. A lot of that capital is not going to places like where I grew up in West Baltimore, right? And even if it does, it's not really impacting in a positive way as much as it potentially could do, right? And so that's the conversation we want to have today. We have a panel of expert practitioners, individuals that I believe have been really innovating for quite some time, not only just innovating, but really coming at it from a perspective of human-centeredness, which I think is really important in these conversations as well. We also talk about innovation, but how do you really center people? And I think these are all folks that have really done that exceptionally well and are people that you can really model yourselves after. So with that said, I really want to start the conversation with this real kind of, I'll pose it to everyone, but I want to start with Astrid, actually. Yeah, see, there's already some giggles, so people already know. They already know Astrid. So I really want to start this off with this question of, how do you all see, how do you think about where capital flows for impact really is from a market perspective at this point in time? Like your own opinions of it, which you've experienced directly. So I'm going to start with Astrid.
Thank you, Rodney. I brought a prop. You're asking me about what I think about capital flows for impact. The emergency clown nose comes out. Because as Rodney said, Gin is celebrating $1.6 trillion in impact investing, and it's not going to the places where it's needed, right? There's plumbing seems to be missing. And my own personal experience with this stems from being a tech entrepreneur for impact. Recovered nonprofit executive turned tech entrepreneur, started to try and raise venture capital 10 years ago, only to find out that my fabled ability to sell ideas and receive funding for them seemed to have dried up. Nothing had changed about me, except now I sometimes wear clown noses in serious settings. But the rooms I was in had changed. And I'm not what you would call underprivileged in the big scheme of things. But here I was hitting some of the systemic barriers to investing that so many women and people of color face every day, right? And I think at the time, the percentage was something like less than 2% of venture capital was going to women entrepreneurs, and it's even worse for women of color, of course. Everything is always worse for women of color. And you know what? In the last 10 years, that percentage has not changed. That's why I'm wearing the clown nose. The percentage is not moving. Capital is not moving. Now, my company happens to be building impact technology, trying to mobilize, we believe, at Armillaria, we believe, that the capital is not moving in part because the data are not moving. We're not good as a sector at sharing data and making the true opportunities visible. But that's only a partial answer to what needs to change. But I became a capital activist by accident because of the challenges I was running into with an impactful company, and there are millions of them out there, and they're not, I don't know who's getting the 1.6 trillion. Don't think it's anybody in this room.
You want to change that, right?
Please.
Actually, Allie, I'll ask the same question to you, and also just recognizing, particularly because you and Dan work directly with entrepreneurs, and so the perspective that you have in terms of sort of the challenges and opportunities as it relates to capital inflows is quite unique. So.
Yes, I was not expecting to go after Astrid putting on a clown nose, so I'm still kind of recovering from that. So I was actually at the Gin last week, and I know there's a number of folks here at SOCAP that were at the Gin last week who were celebrating this $1.6 trillion mark. And I wasn't actually expecting to be the one with the bright spots. But I will say there are a few bright spots. One is that there is the same market sizing report found that there is a significant increase in the use of alternative structures, including like 104% increase in the use of equity-like debt, which is, I think, part of the conversation that we need to have to unstick capital, which is we are very focused on certain types of capital and not so much on others. The other is that we are seeing bright spots in our own portfolio of companies that are able to successfully go on and raise capital. We've just done an assessment of the overall follow-on capital that the companies that we've supported over the last 15 years have been able to raise, and it's upwards of 6 or 7 billion. We're still getting the exact figures, so it's not insignificant. And so there are bright spots, and we do see the same. We see every day the Astrid story, right? The challenges that an entrepreneur has with an incredibly compelling idea, facing systemic barriers, whether it's because of who they are, where they live, or the problem they're trying to solve that somebody doesn't understand who's in a decision-making seat. And we really need to, I think the last thing I will say is that we haven't seen a dramatic shift, in spite of a lot of talk about changing the power dynamic in the overall space of decision-making, and that's another reason that we are getting stuck.
Yeah, there's so much in alignment with Allie. The thing that I would add is that working with entrepreneurs every day, we see that a number of tools that just are not fit for purpose. And Allie alluded to that we're starting to see more use of alternatives. We have to really increase that. And I think the big thing with our sector, for the folks who are in the acceleration incubation space, that we also have to change is because we saw that the money wasn't flowing. We, I think, did something that was wrong. We decided we were going to build companies in the image of venture capital and not figure out what are the tools that are actually right for the companies we want to see in the world. And I think that is, we're starting to see a little bit of a glimmer of that recognition, but we've got a lot more work to do in order to actually build tools that make sense for the kinds of companies that we want to see. I often say we're not going to SaaS platform our way out of a climate crisis, right? So if that is the model that we're trying to develop climate innovations with, it really does not fit. It is really not fit for the purpose. So we see all of the same things. We primarily work with women founders, people of color, see them not getting access to capital. And the real realization that I had was getting ready to go into a workshop with a group of Black women founders, and we're getting ready to talk about VC. And this was the day that enriched announced that they were giving the WeWork former founder $350 million for whatever. We still probably don't know what that is. And one of the women asked me, "Why are you talking about VC? I have less than a 1% chance of getting this." And that was a hit to me, and that, this is something we've been talking about, but a real realization that we have tried to fit all of the companies in this one frame, in this model, instead of rearranging finance. And finance is a tool. It is not an end in and of itself. And this is something I remember from my days working in financial services, and it was a real realization. And I think it's important for moving forward and how we think about capital flows.
Before I have you chime in, Steph, I did want to just revisit something that both Dan and Allie raised, because I want to make sure, when you reference alternative structures, maybe not everyone is sort of familiar with the types of things that you're referring to. So, Allie, can you just share a bit more and even maybe share some of what VilCap has done, and Dan, same?
Sure. So, I think innovative finance or alternative finance, you've heard probably two different nomenclatures. A lot of this is actually things that have been out there, tools that have been out there for a long time and are underutilized. Rodney, I know you are thinking about this a lot too, which is either changing the structure of the financing instrument itself. So looking at tools like redeemable equity, for example. If folks don't know what that is, I'll try to do my best to explain it in a tidbit, but is essentially a self-liquidating structure that allows an investor or a founder to sell back shares to an investor after a trigger event. And so it creates an exit without having to have either a secondary come in or in the very rare instance that at this point that a company goes public. There's also changing the time horizon. So there's the need for a lot more patient capital. Of course, we know we're all very familiar with the 10 plus 1 plus 1, 2 and 20 structure, which really puts pressure on companies to grow essentially at all costs within a specific period of time. We need more patient capital. And then there's use of tools, of course, like revenue share and twists and turns on all of those instruments. And then there's sort of how do you innovate on, I alluded to this, the decision-making process. So thinking about things like what Village Capital does, which is a peer-selected investment process, or thinking about how the ownership is structured. And I know Astrid has done a lot of work in this space as well.
Really appreciate that. Thank you. So Steph, can you share, actually, I mean, you have I think, pretty unique perch in terms of trying to, unique perch, in terms of trying to create different means in which investors can actually shift their mindsets to, and also position themselves to be much more effective in terms of like actually innovating and getting capital out. So can you share about that?
Sure. Great to be with all of you today. So I'm going to start everyone with a question. I want everyone to participate with me right now. So you're going to raise your hand. How many people in this room think we have enough money to solve all of our problems? Raise your hand. How many people think we don't have enough money to solve all of our problems? So fun fact, there are 6.5 million people in California with $1 million of resources or more. Do you hear that? And so what Rodney said, I actually am like the other side of the coin. Our nonprofit is a spin-out academic center, but we're really an investor accelerator. And we think part of the key reason capital isn't flowing is that there's very few places for individuals, foundations, family offices, and companies to go through an investor accelerator process to get non-conflicted, unbiased education from somebody who doesn't want something from them. And so when I look at California, I'm based in Colorado. We support place-based and community foundations all over the country that are starting their impact investing journeys. And when we look at them, there's very few places for them to go to learn how to invest in women and people of color, straight up, to heal, repair, and restore. So when I look at a state like Colorado, we need 50 investor accelerators. You look at the state of California, we need 300 investor accelerators going. The only way we're gonna unlock this capital is we have to acknowledge that the same support we're providing the entrepreneurs, we have to provide the capital stewards. And they have to do two things. They have to get the technical expertise, but they also have to get the anti-racism work too to solve race and class issues. So it's two pieces on that. And I'll finish this part of the answer with saying it doesn't matter if you're in North Boston, one of our clients is Essex County Community Foundation, or Duluth Superior Community Foundation, or Santa Barbara Foundation. We, Jackson Hole Community Foundation, most recently we did Community Foundation of Northern Colorado. And they pick the topic that they care about, and all of them pick housing as their #1 issue. And we start the conversation with the housing, and I say, well, how much money to solve the housing crisis? How much money would it cost to house everybody in Northern Colorado? And they figure out the number of units, we multiply it by the amount of money. It's a big number. And then I say, we need 20% of that. The banks will give us 80% of it. Just like when you buy a house, you put 20% down. It's $740 million. It's a lot of money in Northern Colorado. And then I go to Wealth Engine or Donor Search, and I say, how many people have $1 million or more? I put it into AI, and I'm like, you have $180 billion of private wealth in Northern Colorado. You would have to mobilize to house every single person in Northern Colorado. You would have to identify, educate, and activate those investors to invest 0.5% of $180 billion to solve your housing crisis. Are you willing to mobilize that money? Are you willing to learn how to develop an investor accelerator to identify, educate, and activate that capital? And to Rodney's point, when we teach it, we shift power to the entrepreneur or to the project or to the housing developer and say, what do you need? Let us help you reverse engineer the capital flows. And we call it a cake transaction. We believe we can oftentimes give the capital steward the same risk, return, and liquidity that they need, but providing negative blended interest rates for the community steward.
Thanks for sharing that. I think one of the things I really appreciate about this, and Stephanie just pointed it out as well, emphasized this, is that there's oftentimes an assumption that the asset owner or allocator actually has the capacity to execute against these aims. And so this kind of really reframes things to say, actually, it requires some capacity building as well, right? And kind of shifts not only the power dynamic, but the expectations, right? And sort of like the expectation that we have of asset owners and allocators. So appreciate that, Steph. One thing I'll kind of ask this question to everyone, because I know I've been in this, what we now call impact investing, and sort of, different types of spaces and work for the last 15 years or so. And oftentimes I find that I'm having the same conversations, right? And I'm sure that's something that's been felt by folks in the audience as well. And there's this question that, I think we recognize that there's a lot of different solutions and opportunities. I mean, Allie brought up one, for example, or a few. I'm just curious about what are sort of the things that you're seeing from a solution standpoint, and this question around why is it not being adopted? What's the challenge? What are the challenges there?
I'm happy to go first. I would say that that we have a big narrative challenge, frankly. A lot of the resistance that we get as it relates to the use of alternative structures is actually from the entrepreneurs themselves. I don't know if you experience this at times too, Dan, but entrepreneurs have a lot in their face about how glorious it is to raise venture capital and raise the big rounds, right? And get the big headlines. And majority of the narrative on the TechCrunch disrupt is happening down the road, and a majority of the narrative is on these sort of big success stories and these hyper growth companies. And of course, it's understandable. People, want to have the glory associated with that narrative. The media doesn't want to cover like the boring companies that are actually quite impactful and have collectively quite a huge potential to solve all of the housing crisis, all of the challenges that we have. And so I know there are a few probably folks in this room who are trying to change that narrative through their own media ventures, but we need more of a narrative change, I think, to start with and including with the entrepreneurs themselves.
I'll be going down the line. Narrative change is a big one, and I think thought leaders in our own sector here, sort of in the larger impact sector, have done a huge disservice by adopting concepts like impact unicorns. I think there's been a lot of damage done by adopting the language of Silicon Valley in probably a well-intentioned attempt to find a shared language, and it's just not a shareable language for the problems we're trying to solve in social enterprises. I mean, that's a really big one. I'm struck, Steph, your programs make so much sense, and it's so straightforward, right? And you hear her talk about it, like the numbers, it's not rocket science what we're talking about. It really isn't. And yet, but the program hinges on people being able to self-activate, to seek out programming like this. And I can't tell you the number of times I've been in boardrooms at like a family foundation, for example, where the current generation of boomers and Gen Xers are actively antagonizing the next generation and are telling them they're stupid or silly for thinking that, the corpus of the foundation should be invested in alignment with their principles. And I won't name names, but I literally heard a dad say to his daughter, "Oh, you just don't understand. We invest in the marketplace so that we can make more grants." And like, why were a bunch of us so-called experts in the room to tell them about impact investing? Like that internal barrier is huge. So one of the things that gives me a little bit of hope are, you'll be shocked to hear, subversive initiatives. Like one that I'm engaged in across the Atlantic with some folks at the Joseph Rowntree Foundation, where we started an initiative to hack the wealth defense industry. And now we're literally looking now and have been looking for people who are working deep in the innards of the models and protocols and advisory firms who are working on hacks that equip next generation wealth holders and current generation wealth holders to realign their practice with their principles.
I think building on that, one of the challenges that I see is that philanthropy, the folks that could go first with the more innovative instruments, are among the most conservative.
Fiduciary duty, fiduciary duty, fiduciary duty.
Fiduciary duty, but you'll see a foundation president get on stage and say we're all going to die in 50 years because of climate is an existential crisis. I agree. But they'll manage their endowment in a way that it should exist for the next 300 years. So you all can do the math. It doesn't make sense. But this is the group of folks who can do the most. When we talk about actually catalyzing some of these new instruments, they can do the most. And I think we do have to do a better job of calling them out for not doing it. And maybe not everybody necessarily has to be a spend down foundation, but if this is what you're committed to, if you're talking about existential threats to the planet, then your capital should be allocated in that way. And actually, it is the sector that it has the most freedom. No one else can allocate that capital with as much freedom. I do still think we do need other instruments, right? And this goes back to what Allie was talking about, having kind of force fit everything into VC. How do we fund companies that are good, solid companies that have 5x, 10x potential, right? That a VC who's doing their job would not look at, right? Because they can't fit the current model. We do need new instruments to think through how do we fund these solid models, take a different approach. It doesn't always have to be gambling. We can do something that is a little bit more grounded. Actually learn things from PE, right, which was not something I expected to say, to actually create some new models to catalyze innovation, I think, in a different way. So I think we need new instruments. We also need the folks who have the flexibility and the capacity to actually lead.
Plus one. One thing I want to address too, you said finance is a tool, and I'm thinking finance and capitalism, and I'm a recovering scientist. So if you ask me, is capitalism a good thing or a bad thing? I'll say it's a tool, and it can be used for good, or it could be used for bad. It could be used to restore, heal, and repair, or it could be used to harm. That's my belief. I would not be shocked if you all had disagreed with me on that piece of it. And the question is, we've never had that experiment to see what would happen if we bent capitalism in a way to repair, restore, and heal ourselves. And so I think that gives me hope that one is a tool and a governance issue. And then the second piece, I think about when Allie and I had dinner a couple years ago in DC right after the pandemic, and I said, how can we help you? And most of us on stage here have been, most of our careers in the capacity building backbone space. We're not in the front lines as much. And for us to raise unrestricted dollars is deeply painful to go get somebody to write you a check for $250,000, $500,000. And and they're the people I admire most in these, the people on stage and we have another 50 friends that these are the people I admire most. And we're competing with each other for a little bit of unrestricted dollars. And I'm like, aren't we smart enough to create our own Newman's Own model? Aren't we smart enough to start one or two companies ourselves to fund our movement? Like, why are we playing the victim here, the villain, victim, hero, going, please give us some more unrestricted dollars? Why don't we grow a couple companies to fund ourselves? And so I think that's what gives me really a hope of like, wait a minute, there's 50 of us, we all love and care about each other, we're too busy, we can't hang out because we're just fundraising all of the time. Let's take a step back and create a couple Newman's Own. But let's come up, be more creative. Instead of selling spaghetti sauce and pizza, let's figure out how we can sell goods and services that are aligned with our movement. So I'm pretty excited about the ability for us to create a couple companies to produce profit to fund each other.
I really appreciate that. And one of the things, plus 100 to all of what you said, all of you. One of the things that comes to mind to what you said, Stephanie, though, is at my prior organization, one of the dreams that I had was that what would it look like if we can actually engage each other to develop our own funds that we invest into directly, right? Maybe to your point, we can leverage foundation investments, but how can you actually bring in more diverse set of stakeholders to actually perpetuate the things that we want to move forward, and sort of say, hey, we're coming in, to your point, like we're coming in with 20%, right, 25%. Now you come into the water as well, right? So those are some things to think about, the opportunities that we all have to sort of think outside the box slightly, but to partner in different types of ways that can create more leverage. Astrid, one thing that's I think about in terms of this conversation, I know you've got the inclusive capital exchange, right? And so there's this piece, and I'm going to butcher the numbers, but I think about what Anthony was saying earlier in terms of we've got this enormous challenge and problem in which, like, who actually owns the capital and who actually makes the decisions in terms of allocating capital. And one of his points is that you'd have to have like $100 billion Black or women-owned fund managers to even make a dent. And so one of the things I think we find is that the challenge of actually who's allocating the capital. So I'm just curious, and actually anyone can participate in this part, but just recognizing, Ashley, that you have the inclusive capital exchange as well.
Yeah, so for those of you who don't know what he's referencing in the program, you may, I don't know actually if everybody can see that there is a session called the Inclusive Capital Exchange. Most of you are not invited because we're running it as an experiment. It's the first pancake where we say, how about, these are expensive conferences. You've all taken out time out of your busy work. Many of you will have spent full freight to be here. These are very expensive conferences, and the kinds of people who have capital to allocate and the people who are looking for capital all happen to be in the same room. You're just not talking to each other. And so part of what we did as part of this track was to challenge the SOCAP organization and say, what if we actually made space to connect up capital allocators with those who are deploying it. And we put a particular emphasis and focus on emerging fund managers, because to the points that were made earlier, what we see happen time and time again is that underserved entrepreneurs have come to the same conclusion. Let's just create our own capital instruments. And so when we put the word out, something like over 120 emerging fund managers who are raising funds 1, 2, or 3 declared themselves interested in participating in a matchmaking session right here at SOCAP because they're actively raising. And they're raising something like, I've stopped doing the numbers, but it was, last time I looked, it was over $3 billion worth of capital they're raising to deploy to social entrepreneurs serving underserved communities, right? So I think if we can enable the fund managers, we could potentially unlock capital more quickly. And then we looked on the LP side, and I now need 2 hands, but barely, to count the numbers of LPs who declared themselves, because guess what? We are not doing this as a pitch event where you as an LP just get to sort of observe all the talent who desperately tries to get you to invest in them. We said we actually only want fund LPs in the room who commit to writing a check by the end of March. And we're running this as a time-bounded experiment to see how much capital will actually be mobilized at this SOCAP. And I think we've also, as a track, as a panel, as a curation panel, we've also asked the SOCAP organization to instruct all the moderators to ask a question about how much capital could be mobilized by the interventions being discussed. And I would love it, also, recovering scientist, go Bears, UC Berkeley. You know, I would love to be able to tally at the end of SOCAP how much capital is actually being mobilized as a direct result of what happens at gatherings like this, and how much more capital could be moved if all of our ideas that we're producing and talking about on these stages are implemented.
I'm gonna mix it up on this one. During the pandemic, it was horrible. In Colorado, because we had identified, educated, and activated 155 new investors, we were able to raise $28 million in the first month of impact investment capital. That's what happens when you activate an investor database before there's a problem. And we had this beautiful character-based lending program, Main Street Mike, who I connected Astrid to in Oregon way back when. He's the largest SBA lender, and he created a character-based lending program in Colorado. Good ideas, good character, bad or no credit. We have a pre-pandemic 3.42% default rate. And they came in, and we have Techstars and Brad Feld in Colorado, and I've supported our governor on impact investing, and they called the venture capital people to design the safety net after the pandemic. And I was talking to this man, and I said, why are you creating a new program? We have an existing one that works better for the investor and better for the person borrowing. And he looks at me and he says, Stephanie, he who has the gold makes the rules. And the smoke was burning in my ears on Thursday and Friday and Saturday. Then I thought, on Sunday came around, I thought, she who organizes the gold has way more power than he who has the gold. And so we've been looking, we have a nonprofit holding company. We have about 10 companies inside of it. And we're like, which one's going to make the most money the fastest? Which one's our Newman's Own? And when I say that, the company sells spaghetti sauce and pizza to fund their nonprofit activities. I'm like, which one of our companies are we going to scale fastest to fund everybody on the stage? I'm like, we're going to start a state-chartered bank. There's an $81 trillion of wealth transfer going to women and youth. It's not actually going to women and youth, it's going to their trusts. And there are bank trusts and there are independent trusts, but there is no independent trust 100% focused on impact investing. People would look at me and like, you're gonna give up so much money by not managing the money? I'm like, that's right, because she who organizes the gold has way more power than he who has the gold. And so we'll be running RFPs, and we'll be having a list of preferred CDFIs, emerging fund managers, nonprofit lenders, and we're like, oh, this brother and sister, they just allocated $100 million to us, and she cares about anti-racism, she's queer, the brother cares about climate. If you want to manage this $100 million, this is what you're gonna have to do. We're running the RFP, and we know how to hold your feet to the fire. She who organizes the gold has way more power than he who has the gold.
Organize the gold.
I don't have anything to say about that. Can't follow up on that. But I did. So one question I have for everyone, and this is one of those things that, I mean, Dan, you brought this up in terms of the opportunity that foundations have to lean in. Steph, I know that you've done a lot of work with donor advised funds and like how to like actually leverage DAFs as opportunities to sort of quote unquote de-risk investment opportunities. I'm just curious, what is sort of like the affirmative opportunity that foundations have? Like, how do you each see an opportunity that foundations and other philanthropic capital holders have in terms of having more capital circulating and how they can leverage their endowments or their DAF pools?
I mean, honestly, the biggest opportunity is changing how they're thinking about the future, right? And this is actually my big push for foundations. This idea of that we're going to throw off 5% in perpetuity forever, I think is the wrong idea. So there's a big move a few years ago led by the Heron Foundation to move 100% of foundation capital into alignment with their missions. I think that's great. There's honestly has not been nearly enough of that in philanthropy yet. So there's still a big way to go in terms of actually moving 100% of total capital into alignment with mission. So that's first. We still have a lot of work to do there. But I do think actually deploying more of the capital with a different understanding of what this capital preservation should look like. And that it doesn't necessarily have to be forever. In fact, if you're actually trying to solve problems, maybe it shouldn't be forever, and particularly when you're describing problems as existential. So I think that those two things are the first and foremost, the things that need to happen. Of course, once you get beyond that, that's when you can talk about looking at different kinds of instruments and leading in different ways. And you saw some of that happen with different rates of success when folks were more interested in social impact bonds, but that sort of died down after sort of a change in administration. So there are these opportunities, but I think first and foremost, it's get 100% of the capital aligned with mission and then actually deploy much, much more of that capital.
what he said. Yeah, I remember a few years ago, right before the pandemic, being at an event organized by the Kaufman Foundation on revenue-based finance. And they poured, for some years, several $1 million into the development of this new sort of asset class and new fund managers in that space. Great. And I sat at lunch with their chief investment officer of the foundation. And because of foundation rules, it was something like she couldn't, how did it go? Like she had to, something like about 1% of the endowment, and she couldn't be more than 10% in any one fund. And the upshot was she couldn't write a check smaller than $25 million, and the smallest fund she could invest in was $250 million. And at the time, there wasn't a single revenue-based fund of that size, because that's a second or third generation fund, right? And so the incredibly unsexy answer to your question is, revise your organic documents, review them, and see if they're still future-proof. Are they future-proof? Like, do you have to break up a trust? Do you have to, and the second thing, also super unsexy, but we have to review and revise and edit our definition of fiduciary duty. People think it's about just financial capital. It's not, it never was, right? And so there's some sort of back to basics work that needs to happen inside foundations that nobody can do for them. And on the external facing, I think they could do a hell of a lot more in terms of investing in efforts like what Steph was describing, or what some of us are working on, like, again, super unsexy. Nobody wants to touch everybody wants AI for good, right? Nobody wants to invest in the data standards that have to be developed to actually mobilize and standardize information across the sector. Newsflash, you cannot train an LLM on unstructured data, but that's what we're sitting on. And so it's super unsexy. Nobody wants to take my phone call when I want to talk to them about a standards program for impact data. Those are some of the 1, 2, 3 things they could be doing.
Yeah, I mean, I would plus one, the investment in infrastructure, the sort of infrastructure to rethink and recreate the system. I think we also need to talk about why don't foundations want to change their behavior? Why are they not willing to revisit their documents? Like, we need to change, foundation boards need to change. These are mostly folks who do never come into these rooms, ever. And until that changes, we're not gonna see at the level that we need to. I mean, I've seen a lot of folks go into foundation leadership with progressive ideas on how to make those changes, how to shift some of the dollars into impact. And they're not able to move at all, even over 10, 15, 20 years because of the structure of boards, because boards are still clubs that most people can't get into.
Does anyone know the most impactful community foundation in the US? Anyone? It's $34 million, the Women's Foundation of Colorado. Every single dollar is invested in women and people of color. Small staff size. They can do it, any of them can do it. There is no excuse. So going back to +1 on the narrative, for the ones doing it well and right, we need to learn who they are, read their case studies, and become the champions. And we need to get comfortable being uncomfortable and being courageous. It doesn't matter if you have a small donor advised fund or you sit on the board of a large family foundation. If you have the courage to say, we're gonna do this, and I'm comfortable making you all uncomfortable, that is the courage you need to do this. We rolled out a community foundation landscape scan this last year with 9 case studies of community foundations doing incredible work. On the last webinar of the series, we had 650 people sign up on a webinar. At the end, 3 years after the pandemic, over 200 community foundations. I get this guy blowing up my phone. His name's Sean Florick. He's out of Duluth Superior. He's like, hey, you figured this out, haven't you? And I said, yeah. And so I'm like, I have college roommates there. I reach out. I'm like, is this guy real? Do you know him? And they write back, and they're like, he's the real deal. In fact, one of the husbands worked for him. He was a district judge for 17 years and created restorative justice programs that got replicated around the world. And he's like, why aren't people doing what you're training? And I said, well, you have to have courage. And he's like, I've put single moms in jail. If you have a way to solve our housing crisis and solve the wealth and achievement gap, I will have the courage to do what you want me to do. And so one, it takes courage. It's almost like you have to have an alternative persona that is like, I'm going to be a shareholder activist on a board or with a donor advised fund, and we're going to do this. And the good news is, when you get that courage, or you realize you only have one life and why are you playing it safe, and you're like, I'm finally going to do it. When you do, there is enough infrastructure and plumbing behind the scenes to help you do whatever you need to do. And so that's the great news, is we are building that plumbing. It does exist. If you want to have the courage and push, there's a way to get the capital to flow. And to Astrid's point, we do have to, if we want to stay within the system and try to fix the system from within, we have to meet the system where it's at. And right before the pandemic, I sat down with a $3.5 billion foundation. It was the number 2 person, Bruce, who has since passed, and Stan, who's since retired. It's the Colorado Health Foundation. And we were all 3 really good friends. We sat down for breakfast, and I said, boss, you're going to sit and watch Chief Investment Officer and I have a conversation, and you're just going to eat your breakfast. You don't have to say anything. And I'm like, Stan, why is it so hard to invest in emerging diverse managers? And he said, well, you know, Kresge Foundation has 13 staff, and we have 2. Bruce almost like upchecks his breakfast. He's like, what do you mean, on the program team? He's like, on the investment team. Stan didn't tell his boss that they were understaffed. And he said, you know, they're higher risk, not because they're diverse, but they're emerging. You know what boss said, Bruce? He's like, we'd give them grants. He's like, you would? Chief Investment Officer didn't know that was a possibility. Number 2 person didn't know he should be offering. And he's like, there's 2 staff, and we have to allocate $3.4 billion. Our minimum check size is $25 million. We can't be in more than 3 to 5% of the fund. And so the whole thing was just like watching those 2 understand what the problems were that they weren't sharing with each other. And they outsourced at that time to Towers Watson. The minimum emerging manager database starts at $500 million, right? And so I got off and I called 2 of my mentors, Lloyd Kurtz and Tom Koo. They were the first 2, employee number 2 and 3 at KLD Analytics. I'm like, am I missing something? Why don't we go get 100 to 250 capital stewards who are committed to investing in, start with emerging diverse, but then emerging climate, then emerging Pacific Northwest. Why don't we start with emerging diverse, and why don't we go share and split the cost of the due diligence? Because when you're asking an emerging manager to go through a DDQ, a due diligence questionnaire, that costs them $20,000 to $60,000, and they're going through the same one over and over and over again, I call it group assault. There's no reason we can't borrow from the common grant application and split the cost of the due diligence up to the point of giving advice so they can all get that advice. And it's like, it's a divest invest movement of like, let's all commit to 20 million in emerging diverse managers and have 250 of us do that commitment over 3 years and split the cost of the due diligence. So there are ways to do it, but it requires more people up on the stage of like, wait, how is it working? How do we reverse engineer it to work so we can make it flow better?
Yeah, what I really appreciate about this line of conversation as well is the fact that, you know, Ashley, you call it, you know, the unsexy things, but the reality is that most of the things that need to be done fit into that category, right? I think oftentimes we think about these conversations and having to construct the most innovative process or what have you, and actually it's really updating certain processes that were created decades ago, potentially. Recognizing that, as I said earlier, that there's even capacity needs within asset owners and asset allocators that, you know, 2 staff, well, actually a number of institutions are in that same bucket, right? That's not unique at all. And so how do you, to your point, Stephanie, how do you make sure that there's opportunities for spreading some of the task of the work itself to make it much easier for things to occur? So this has been really, really great. I would offer, I'll ask the final, or well, not the final question. As a reminder, if you have any questions, please do jot them down because we're going to open up to Q&A soon. But one question, but one question I would just offer to you all as well is, as you think about like an action item that can occur, like from the folks in the room, what's one thing that you would hope that people can walk away with? Don't be shy.
I've never been more afraid and more hopeful. We don't need their money to solve our problems. If we come together, there's enough money for us to solve our own problems. We need to get in the driver's seat of the governance of our money. We have enough money in this room to solve all of our problems of everybody in this room from the financial side of it. Not the other sides of it, but the financial side of it. And if we can get out of the mindset that over there, if they would give us money over there to solve these problems, and if we could mobilize our own money to solve our problems, we have enough money and we can totally do this.
Yeah. I'd add just walking away with a question that I'm going to be asking myself my entire time that I'm here, and I bug Allie with all the time, which is, what if we started from a different place, right? What if we started with, as I said before, with what do we need to grow the companies we want to see, right? And what would it take for us to build mechanisms to do that? That is, the thing that I've been thinking about and will continue to think about this week, so that I can start thinking differently about how to pull different sources of capital and make that the journey versus pushing folks towards what the existing structure looks like.
I share the hope that better coordination and collaboration is possible, and I think there are more and more of us who are willing to roll up their sleeves and get really real with each other. I would also say that get comfortable with making other people uncomfortable. Like, I actually test as an introvert. It's not comfortable for me to put on a clown nose on a stage, and yet it makes the point more vividly than anything else, just about. It's so absurd. Like, don't be afraid to call out the absurdity where you encounter it, and just ask that nagging question, like, why is your chief investment officer the highest paid person in your foundation? Why do you accept Monte Carlo simulations in your financial planning tools, which don't make sense in a stochastic world that we live in? And I can deconstruct that sentence for anybody who wants me to afterwards. And go with your gut feeling, right? Like that young woman who said to her dad, like, if we're so serious about youth and racial justice, then shouldn't we be aligning our entire endowment with those values, right? Like, so I think we, especially if you're of an older generation, you can model that behavior of pointing out that the emperor is not wearing any clothes and what he's doing is absurd. So I encourage you all to do that.
I think this is kind of building on what you all have said. If you're in a position where you hope to offer help to somebody, start by listening to what they need instead of deciding how you're going to help first. So instead, I think we spend a lot of time in these conversations for those of us who support entrepreneurs or support emerging fund managers, thinking about what it is that they need support with, what capacity they need help with, versus truly, truly, truly sitting down and listening. And if you're in a position where you need something, ask for what you need, and don't be afraid, adding to the don't be afraid to make people uncomfortable by doing that.
I was just going to give a real-life case study of this. One of the ways we teach an investor accelerator, we call it an impact investing giving circle, and we're on our fourth one with the Women's Foundation of Colorado. So instead of women donating money to give to women of color, they donate money to learn how to invest in women of color. And to your point, we were talking about before this session, most recently, we've been in a lot of debt investments, but this first one came up with an equity investment. We have a Native woman-led film company. And we said, what would be equitable equity? And we finally, and it's so funny because whenever we do the call for social ventures, the women and women of color are in the room and they're like, but what do the investors want? And I'm like, oh, no, you're not hearing us. We want you to pay yourself a thriving wage, your workers a thriving wage, and even if it's negative, that's cool. We just want you to do that. And they're like, yeah, you're not hearing us. What do the investors want? I'm like, no, you're not hearing us. And finally, on the third time, they start crying. To Allie's point, nobody asks them what they need. and says, what if you paid yourself well and refinanced your debt and increased your wages and got you into homes? Like, what do you need? And so we were like sitting there and we're like, what's equitable and fair for this Native woman-led film documentary company? And we did 1.25x off after profit. We're like, pay yourself well. And if you make it, great, give us a piece back. But that's what we're talking about of, like, what do you need? Listen and reverse engineer the capital flows.
That's really great. And by the way, Allie, your advice could be applied to anything, so I appreciate that. We all need to do better listening in general. Okay, so we actually have our first question, and it's going to you, Astrid. I'm sorry, back on the spot. Astrid, you mentioned working on the hacks to reform, reallocate wealth to restore us. What are the hacks?
Funny you should ask. We have just closed a first Open Innovation Challenge. I think the website is hackingwealth.xyz. And we're literally in the process of doing the final judging. And not tomorrow, next week, we will announce the first 6 recipients of a short a small cash award to finance a short sprint, where people will be leaning into the work they have been doing in a number of different categories. So, for example, is there something we need to do from a legal perspective that can be accomplished in a 6 to 8 week time frame that, if it succeeds, can redirect wealth, right? And so the categories are roughly, see if I can do them all. There's legal, there's accounting, there's finance and wealth advising, there's digital technical stuff, there's behavioral. There are some really interesting entries that I, of course, can't talk about, and that go to the heart of this question, like how do you help people change behavior? And then this is all very new, and so we're working on, we hope to turn this into a growing community of people who understand themselves as hackers inside the wealth defense industry, with the sole purpose of breaking it and making it just. So stay tuned, I think is the short answer.
Yeah, just real quick on that, Astrid, the wealth defense industry, can you add more color to that?
Well, as the name might suggest, so it's literally the people who have taught entrepreneurs, to not ever talk about what they need, because, the wealth advisors. Here's an example. When I was president of EcoTrust, we launched the EcoTrust Forest Fund, and our cornerstone investor, Evergreen Fund, every quarter we would send her the investment reports, and every quarter her wealth advisor would put that report into her charitable portfolio. That man is a perpetrator of the wealth defense industry. The lawyers, accountants, people who are working sort of on the operational and back office side of basically helping you steward and grow your wealth in ways that don't do any of the things that we've been talking about. And we're calling it the wealth defense industry. It needs to be hacked by whitehead hackers.
I'll preview a session we have on Wednesday. It's called the Easy Button. And so how do we meet them in the middle? What's the hack for that? Investment advisors make money on assets under management. And so there's a magic little tool called a QSIP code. And I just learned it costs $350,000 to create your QSIP code, all in. And if we can figure out how to scale the good work on the stage up to 50 million, 100 million, 350 million, and we can have enough funders say, let's give a QSIP code to that thing, all of a sudden, Jim at Merrill Lynch will not fight you putting the money into that in the same way he's fighting you right now, your own money, because the QSIP code allows him to put the money into it without him losing assets under management. And so if we want to hack that piece of the system without changing it, we need to get a pilot, we call it phase 2 of the National Impact Investing Marketplace. We need 10 communities to source deal flow. Let's start with Black women-owned businesses. And if we can source $250 million across 10 communities, plop on that QSIP code, hand that QSIP code over to the investment advisors, that will allow the capital to flow in a way it hasn't been flowing.
One thing I just wanted to point out that I appreciate about what you just said, staff. I'm going to answer my own question because one of the things I actually think a lot about is the fact that there's this incredible opportunity to disrupt the regulatory environment in a way that actually encourages and allows for different types of folks to actually invest in impact. And the example that I consistently think about is, I grew up in West Baltimore. My parents purchased their first and only home back in 1995 or so. That home's value has increased by like 1.5%, right? I mean, and this is something that happens in Black households across the country. Having said that, one of the things I think about is that I recall being in a conversation on a panel where an impact investor was pointing out that 5% was not a market rate investment, and I thought about that, and within the construct of framing of it, I said to them, well, the reality is that people like my parents would love to take 5%. That'll be a win. And so I think part of this is also like considering the regulatory environment in which we operate in that really does from private capital. It really is going to, it's purposely set up such that folks that are most impacted by these issues aren't even able to participate economically. Okay, sorry, that was moderator's privilege. So I've got another question. Okay, so I'm just going to read it directly. Power question for all capital allocators holds so much power because they hold the funds, but very little effort goes into sharing that power with systematically undercapitalized founders. What are some practical behaviors and actions funders can adapt in order to establish relationships where founders feel safe to ask for what they need and want?
Yeah, I mean, this goes back to the governance conversation, right? How do you change governance and the decision-making structures? Now, for those of you who know who Village Capital is, we have a pretty radical way that we look at decision-making, where we've fully put power into the hands of entrepreneurs to make decisions and become the fiduciary. That's probably a stretch for most. But there are things to learn from that process, which has generated, a more equitable portfolio than a lot of early stage portfolios, and that is bring an entrepreneur on your investment committee. Bring someone from the community that you're trying to support. If your thesis is around a specific community intervention, like where is the community in that decision-making process? How do you bring in other voices? It's not that scary. I know it's Halloween, but...
One of the things that we do at Halcyon is also just putting people physically in the same space. We have the advantage of having a beautiful space in Georgetown, Washington, D.C., a space that many would not expect our founders to be in, given who our founders are and who we serve. And we've seen the power of leveraging the privilege of occupying this historic space, bringing folks who've got the capital together with folks who are doing the innovation, has really demonstrated a really unique way to change the way people talk to each other. And something that I think we lost a little bit during COVID. We thought we could have all these conversations about money via Zoom, but we found that it's really important for folks to really understand the founder and understand the founder perspective. And so that's why we are so critical for that matchmaking.
One more quick thing that I just thought of as you were talking that I've seen other folks do that I think is really great, which is to reverse the pitch. So have the investors pitch to the entrepreneurs. So you're instantly changing the power dynamic because you're reminding the investors that it is a privilege to be able to invest in companies, and putting the entrepreneurs in a position of reminding them that they get to choose who they work with. So that's another thing that I have seen done that has worked really well. Sorry, Steph, I think you were about to.
I'm just going to ask this last question just to make sure got as much participation as possible. And it's our final question, but what advice will you give to entrepreneurs navigating the space who aren't privy to the conversations you have with people who manage capital?
I'll do a twofer. I'll do the last one and this one. There's a saying, people would rather be wrong in a crowd than right by themselves. Have you heard that? And this goes back to courage and risk. And the first person to do what we call full spectrum capital, and how we frame this is Teresa Ish. I met her in the picnic tables of the former SOCAP. Turns out we live 4 blocks away from each other, and she said, she called me, she works with the Walton Family Foundation, she funds the Oceans team, or she's a program officer in the Oceans team. She's like, you gotta teach me this. I'm like, 10 sessions, $2,500, and we did this 10 years ago. She did a $500,000 negative 50% investment, $500,000 negative 50% interest rate investment to a for-profit sustainable seafood company that leveraged a $5 million investment. And then I made the case that that was an above market rate return of 50% to giving her money away at negative 100% loss. And when you think of Teresa, and I have a slide, I'm like, she's major league on intelligence, she's major league on access to capital, she's major league on mission, she knows what she's doing. But she's not major league when it comes to writing a full spectrum capital check. She's never done that before. She's not major league. She's not even AAA or AA or single A or Babe Ruth. She's at T-ball. When people ask me what I do for a living, I'm like, I'm a kindergarten teacher and a T-ball teacher. And the fact is, the capital stewards, pitching them an investment when they haven't hit a ball off of a tee is like all of us walking into the San Francisco Giants and starting to swing at fast pitches. We have to honor that the capital stewards have not been taught how to do this. So I'm going to say how to answer that question as an entrepreneur. Do a monopoly money, play with pretend money. Do a case competition with students. Do a giving circle with little dollar amounts. Like, we have to honor the fact that the capital stewards are actually at T-ball when it comes to learning how to invest this, and we keep pitching them as if they're major leagues.
You know, my advice actually goes back to what Allie said, is we have to remind investors that yes, it's a privilege to invest in these founders. We have to remind the founders that is what they're coming to the investor with, that they're coming to the investor with an opportunity, with an equal exchange of value. And I think sometimes you can really get locked in that power dynamic. We can get locked in it even as a nonprofit CEO going to a funder. But you are providing something of value, and that's something we always want our founders to anchor on, and to not come to it with, you're not asking for anything that you do not deserve and that you're not going to deliver on. And I think that's the thing that we always will remind founders of when they're going into conversations with investors.
I have a variation on some of these answers, which is seek safety in numbers. It's incredibly alone and lonely out there when you're a founder who's solving a really important social and/or environmental issue, and you're seeking capital on terms that, to Steph's point, is outside of the experience of most investors, right? And so what breaks my heart is when you see entrepreneurs who are working so very hard, then also, they're already working hard, doing yeoman's work, right? Trying to solve the world's problems with a business model. And then they have to also educate the investors. And it's incredibly expensive for you as an entrepreneur who has neither time nor money to educate people with all the time and money in the world on things that they should really be learning from Stephanie at a course that I think is vastly underpriced. But that's your challenge. And so the remedy as an entrepreneur is, like somebody said to me years ago, anybody who asks you for an elevator pitch is already the wrong investor for you. So there is, protect yourself, be ruthless in your qualifying of the investors you even want to talk to, and then find groups of like-minded entrepreneurs. And there's some fabulous organizations represented here at SOCAP, whether it's Black and Brown Founders or Black Innovation Alliance, or the organization I co-founded, Zebras Unite. Thank you for your board service, Allie. Where entrepreneurs are beginning to sort of flock together because they share similar attributes on how they're approaching the work. Or another interesting one, the Inclusive Capital Collective, where we started publishing a series of black papers to educate the market. And what we have heard time and time again is when you are that, for example, we did a black paper on real estate investing and how catalytic and philanthropic capital come into the capital stack. And I've heard from several ICC members who are using real estate as a community wealth building strategy. Having that paper in their back pocket abbreviates the investor education process. And so and I think we need more, back to speaking to philanthropists in the room, we need more support of organizations like those to help do the market education, because that is cost prohibitive for individual entrepreneurs.